Hello everybody. Welcome to our first webinar in 24. I'm very happy to have a super exciting topic today about exit planning. As everybody knows, investment is easy, exit is difficult. So we cover that topic together with Alexander. He was recommended to me as an expert, and he did one of the last biggest exits, or helped to make it happen. One of the last biggest exits in 23, Metaco, and he was in charge or working for Post, our Swiss Post, where he has a steady mandate to help them buying and exiting companies. So hello, welcome, Alexander. Happy
Hello,
to have you here.
afternoon. Good afternoon. So thank you for having me.
Yeah, it's not easy to find great experts in that area. So let's see if we can thrill our audience. So before I start, two little things. One is you have a question and answer thing, F&A. Fragen und Antworten, because I have it in Germany. So it's question and answer. If you have any question and answers, put them there. We try to answer them. And we start first with Alexander, introduction himself, and then he will tell you a little bit about his experiences and what he's talking to his mandates or clients when the topic exit is coming in. And then we have an open discussion where we discuss some of the topics I think is relevant for that. Okay, so I hand over to Alexander, a short introduction of yourself, and then please about 20-25 minutes a presentation. What do you think is important to know about that topic?
Okay, so thank you very much, Ralph. A quick intro. I've been in Switzerland since more than 20 years. I'm originally from Amsterdam. I was born below sea level, but given climate change and rising sea levels, I think it's safer to live slightly higher up. So I've been here for quite a while. As Ralph mentioned, what I'm helping Swiss Post and also PostFinance on portfolio management. And some of the issues we deal with is exit planning. Already quite early on in my career, when I worked for 3i, an investment firm from London, but also based in the Netherlands, it was interesting that when we wrote an investment paper, we had to write, actually, there were two things very important. One is who introduced the deal. That was always very important, but also then so to whom are we going to sell this company and what are the plans? And I just noticed quite often when I sit with founders that whole aspect of exit and what it is and how do we deal about it is not very well known and sometimes even a bit scary. So what I would like to do is share a couple of slides and some thoughts and also some situations that I've run into. And Ralph may interject and you may interject with some questions. So I will share my screen and talk you through a few thoughts that I say and learnings. I think you can see my screen. So one of the things is that
we see the screen. That's good. Thank you.
Thanks, Ralph. One of the things that is also the title, and you have to think about it. You want to be bought, and you don't want to be sold. And you think about it, well, when you want to be bought, you want to make sure there's interest coming to you rather than you said, okay, now we start selling the company. And it is actually a very delicate, well, not so delicate. It sounds like a delicate sentence, but it's actually a very big difference if you're being bought or if you will try to sell yourself. And one of the learnings is that meeting founders, there's a bit of a saying that I quasi invented, and I'm sitting out in Geneva, so I can use the French words. It's like I always notice that when we meet founders that we invest in, the founders are very capable of selling un pain au chocolat. They're very selling, okay, we're selling the pain au lait, the croissant. When you talk to them, they're very enthusiastic about it. But when you talk to them a little bit further, like, have you ever sold the boulangerie? It is actually very difficult for them to realize, like, hey, that's a completely different game. And when you start talking about them, you can explain them that selling the boulangerie is actually relatively similar to selling a croissant au pain au chocolat, but only at a higher and a different aggregation level. And let's look at some of the typical founders. They are sometimes young. We don't have too many serial entrepreneurs in Switzerland. So selling a company is already very hard to raise funding, and to sell your company towards investors. But then to think about, gee, when do I sell the company? And what I do with where I help Swiss Post and PostFinance, that very early on, actually quite early on after the investment, we sit down with the management team and start brainstorming. And we brainstorm like, what are the options? And by bringing it up quite early on in the discussion or during the investment period, it also is less scary. And it's not like, oh, we now need to sell the company. No, so we usually sit at the end of the day, or we have a glass of wine, and then we start brainstorming what are the possibilities. I don't usually show a slide, which is a bit of a joke, obviously, and it is it's like, who you want to be depends who will buy you. And I say there's a joke. It's an old 17th century Dutch proverb, which is complete bullshit. But it shows a bit the trading mentality, that also your company is something you can trade, that you have to sell. And what I try to explain there is that you have your company, but who is going to buy you or will depend a lot, and it also influences who you want to be. And in some of these sessions that we do with management, we then start brainstorming, say, okay, if company A wants to buy you, is that because they want to go big in the DACH market? Is that because they want to go big in certain technologies? But it also changes the thing. Okay, what shall we do with the company? And I have to say, this is always a bit of an aha-erlebnis, aha moment when we sit down with the founders, that they start realizing that there is already very early on a relationship between your strategy of the company and your potential exit, and not in a scary way. So we've been in situations where the management team comes and says, okay, or we sit down with a strategy, let's go into the UK market. And yeah, that would be great, and it could be clients. But if you then look at the potential players who could be interested in buying you, of the top 4 or 5, none would be interested in having a UK entity, because either they are there already, or it is not that focus. So one of the key messages is for founders and investors here around the table is to try to match your corporate strategy with your exit planning. And that is really what I hardly see. And it is not only the founders, if I'm honest, because if a lot of investors ask a venture capitalist in the bar in the evening, he or she, what does she do? Or what does he do? So he or she says, I'm an investor, and we invest in young tech companies. How often does that person say then, and then we help to grow and try to sell that company? So it is even also not very, especially early stage investors that may come in the pre-seeds and the seeds and the pre-series A and the A's. Even they may not have that much experience with that whole exit process, which could actually come quite a bit later. So I have to say that also investors, quite a few, don't really have the experience of thinking thinking about it in a concrete way. Now, as you may, why exit? And then we have a whole plethora of different players around the table. You have your current investors. I'm not going to go through all these points, but it is interesting to think a bit about just follow the money or follow the dream. I mean, the current investors, you know, when you have a VC fund, they have an end of fund. If you have a family office as investment, they are much better. And then sometimes also interesting to understand within your investor base, what is really the individual drive. I will give you one example. There can be. I was once in a situation where there was a company where there were certain investors had given a convertible loan, and other investors were just equity holders. And the convertible loan holders were looking forward to convert with the next financing round, and then have a nice upside and a nice run for a couple of years. But there came an exit opportunity. The equity holders were very interested to sell. The convertible loan holders were still quite significant in influence, were not interested. And why? Yes, they made a nice return of, for instance, 1.2, 1.3, 1.4x in 9 months. But the individual investment managers, for the carried interest, it was not at all interesting to sell. So really try to understand, when you look at your investors, also the individual money flows to your investment managers. I mean, moving to the founders, time to cash in. Sometimes we see, you've been in a case where we said, well, let's try to think to sell this company because the founders are getting tired. They just don't see it's going to be a big thing anymore. And they're not interested in what a VC company could have been. And it becomes a nicely growing SME. But it is just not nice anymore. So this fatigue, I've seen it a few times, but it can be a nice moment for then to sit around the table and say, hey, let's try to sell. The board always plays an interesting role. When you are in an exit process, think a bit, when your shareholders' agreement, who's going to run the exit process? And it's a very delicate position. Sometimes the board is in charge of an exit process. Well, it's actually a true shareholder matter. So I've been in situations where the board gets a lot of power, and the board may or not have the same interest as the shareholders, and in situations where the shareholders run the show. And there are type of shareholder agreements and situations where the board has nothing to say about the exit process. And you can imagine that may create something a bit of an ego issue, because certain of these board members feel that they should be involved. And, you know, there are many other reasons why at a certain point in time you want to sell. The markets are good. There's stress in the channel. The multiples are great. We all know at the moment the multiples are not that fantastic. And given that there will be quite a few technology people around the table, sometimes when you have your own technology, you know, the ice may be melting. You know, your technology was great, but people are coming, or it's not that special anymore. That could also be a moment to say, hey, let's start sell the company before the ice has melted. The investment, the objectives. Let's focus on the founders here. What do you want to get out of it? Founders, would you like to stay longer at that company? Would you like, in what role? There can be situations. I did a very nice acquisition many years ago in the Netherlands, where we bought one of the internet service providers. And these were the hackers, these were the rebels, and they just hated everything about this large company KPN, which was the kind of the Swisscom. And they were always yelling and screaming. And then in the end, KPN, I was working with KPN as an M&A director. We did buy this company with a beautiful name, Access for All. But the really nice thing that made the deal was that we put a completely independent supervisory board in between. And from an image point of view, this company could remain to be the enfant terribles in the Dutch market, and yell against all the fixed line and mobile operators. They could really be aggressive to them. And it's very excited that deal structure lasted for more than 25 years. That they stayed completely independent. And that was one of the key reasons. So coming back to the founders, how long do you want to stay involved? In which role? Do you want to be in such an independent situation, or would you like to be a department? In another case, I saw a company where it's bought, and it was not so much money, but the founders company was doing okay, but finally they were absorbed by a large company, and they could have all the technology for them to play with and build new products. So there's obviously a whole set of reasons, but please start thinking early on, and when you are in those situations, what role you as founders would like to have. There's obviously a whole political element, like are you going to sell to a company with the same future? As founders, when you're in this process of being selling the company or being bought, ideally, you're obviously going to say that you love to work with the company, but really try to also be a little bit. When you say I would like to stay for 3 years, your handcuffs are going to be there for 3 years. So those are I'm not going to go into the details of what kind of the slides will be shared, what kind of type of exits there are. I just would like to looking a little bit at the time for the 20 minutes.
Well, you still got enough time. It's okay.
Okay, so I just would like to help you and to advise you. When you start thinking about these exits, sit down early make that list, because I tell you something, the people who are going to buy you, in 80 to 90% of the situations, you know them already. Now think about that. If you think that your company will be bought by a company flying in from Japan saying, now I want to have you, you never met them, those chances are very, very rare. And quite often, a lot in this technology space, we have a relatively complex value chain with partners, suppliers, clients, the distribution partners. And a lot of them can potentially be your buyer, be the company who is interested in you. So what we do advise certain companies, when we made that list, to proactively start making commercial relationships. And when you start making those commercial relationships with either a distributor or a quasi-competitor, or you in the market, or a supplier, you have that relationship anymore already. And especially when you think now it is time to sell, it is much easier to start that whole discussion about, hey, should we not think about a strategic relationship? Or ideally, you hope that at a certain point in time, you will get the phone call from them. Now, so this is a bit of advice for you as the founders or people or investors in the company. Now, during that process in which you are in an exit, you may be surprised if a large company buys you, how irritating that whole process can be. I tell you, often founders already hate the fact to raise money from investors. Adding a exit process to the table is another dimension. I've been in several situations where the company consists of between 15 to 30 people. The deal team of the buying company can be larger, with all the lawyers, and all the lawyers from all the different fields, from all the financial people who have to do the due diligence. It's amazing. And now coming back to if there's more corporates in the webinar, actually large corporations have to learn how to buy young companies or growing companies. And unfortunately, if you go through a lot of the M&A departments, they're mainly most of the time involved in these large deals. But being involved buying a younger company is a completely different spiel. I have been in a situation a few times where the negotiations I've been in a situation where on behalf of a large corporate and on behalf of its portfolio company, I was in the middle to facilitate the whole exit transaction. And you know how it goes. Everybody's very enthusiastic in the beginning, hunky-dory, everything is great, yes, it's going to work, the deal's going to work. And then the whole process always falls at a certain point in time. Doors are being slammed, people don't like each other anymore, etc. And in these negotiations, it can sometimes become quite emotional. And I've done it twice where I took the whole cap table. I ran the whole exit scenario for all the shareholders, because that's always a fight. All the shareholders, you understand, with liquidation preference, old anti-dilution clauses that may kick in. And then you can imagine about earn-out systems for the management where there can be some jealousy. And then do the whole analysis. And I spent a long weekend doing the whole modeling, sorry. And then I had already told them Monday morning, 9 o'clock. And I showed them where they were fighting about. And they were fighting about certain elements in the deal structure. But when you really did all the numbers, it was such a minor difference from a money point of view. And trying to understand when you're the founder or you're one of the investors, try to understand all the interest, the whole financial interest that we call this a waterfall analysis, where you know exactly who will get what. Now, when you do this exit, and often the buyer would like to make sure that the management stays a bit longer, there's the following discussion often. The buyer may say, okay, I have 100% available, I have 100 million available for this deal. But how much of that 100 million or how much more does the buyer have to reserve to incentivize the management? So the current shareholders will say, well, you deal with the current management, how to incentivize them with options or bonuses, but we're not going to pay for that. And in such a discussion, it's actually interesting. The price negotiations for all the shareholders is usually done quite quickly where there's a price level. Structuring the incentive packages for the founders who will have to stay takes usually 3 to 4 times more time. It has to do that it is emotional, and also often that the founders don't immediately push this on the table, but there are also sometimes some tax obligations, or say tax consideration, especially in Switzerland, where, as you all know, there is no capital gain tax. And I just warn you already, if you ever are in an exit situation and the buyer would like to tie the price of partly buying your shares to the performance of the company, the performance company is okay, but if you stay there as an employee, red flags. So just for you already to know, you make sure you completely separate any price for your shares compared to your involvement in the company as an employee. But that whole negotiations about the incentive packages and the role and the title for the remaining management team and to whom they're going to report takes usually much longer than negotiating the key parameters of the deal. So some of those are some of the thoughts and thinking, and I'm open to answer some questions, Ralph, or other people to answer.
So if you go one slide back, you see the options: IPO, trade sale, MBO, acqui-hire, tech sale. What is, in your experience, the most probability or the highest probability? Which one of those sales? So I start with the IPO. I don't believe that IPO is a possibility in Switzerland, so it's almost impossible.
No, Ralph, you're right.
Yeah. What about the next, by your experience, and what is also by success planning or exit planning the most easiest one? I mean, that's IPO is one of the most difficult ones, and therefore I'm convincing that trade sale is mostly probably the ones you should focus on as the most highest option you can have.
Yeah, Ralph, I agree with you. If I see a young team coming up and they are doing their pre-Series A or Series A round and say that their exit is going to be an IPO, I think that's not a smart thing to write on your in your deck. It is around probably 80. I mean, in Switzerland, probably 90%, 95% that you will have a trade sale. And unless you're based in, I would absolutely, also from a process point of view, because you basically, with the trade sale, now we're talking about the financial investors, they will sell immediately most of the time 100% of the shareholding. unless there's a little bit of an earnout. And in an IPO, that's a completely different game with lockups, and you cannot. I mean, the free float may be small, and you can only sell a part of it. The trade sale is also easier to start organizing because of that relationship. You can start already organizing with these potential buyers in the value chain, either competitors or suppliers or kind of other partners. Management buyouts and management buy-ins, you have to have basically a private equity firm will buy cash flow. So you need to be already having a significant amount of revenues, plus you need to be cash flow positive. If you go a little bit down to the situations where it is a bit tough, where you are kind of plateauing, there's not that much growth, then you come in these acqui-hire or tech sale scenarios, which what you want to do, you either want to make sure you get your money back, get part of the money back for the investors, as founders still get a little bit of money, or continue your dream within another setting.
Coming back to the question of the trade sale, is it wise to onboard investors like corporates very early? Because then you have already an option of an exit, or is it unwise to do that, to keep all options open? I mean, you said we have to start the discussions early, and sometimes you have investors who would be interested, but you decline them because you don't have like clients as investor, or you want to have you want to grow the company as long as possible and then sell it to the highest exit valuation possible.
Yeah. I mean, it's actually a very good question. When we say corporate, we have to split corporates in two groups. One is the corporate venturing activity from a corporate, and the other one is when it comes from the balance sheet, when a business unit is very interested in it. If you, as a founder, looking for corporate venturing, I would give you two advice. Make sure that the corporate venturing team has a honesty and a credibility that they will not share any information with the business units. Because one day it may come that the mother co, if you like, of the corporate venturing would like to acquire the portfolio company. And I've seen situations, and I can say Swisspost was extremely rigid in that the corporate venturing team of Swisspost does not share any information in such a situation with the business units. I've also seen it in other situations. But you as a founder, make sure that you get a good feel for that. Coming back to the second category, which are a corporate, there you have to be a little bit more careful, because then it is the rationale for there to invest could potentially more a pre-M&A investment, where the corporate venturing guys and say ladies, they would like to make financial returns in a space that's interesting for the corporate. But when a business unit invests, you have to be a little bit more careful. Go again then to your shareholder agreement and how to do it. I've been in a situation where there were quite a few corporates in the shareholder base, and a company got an offer, or there were people dancing around a company to buy the company, the target company. I didn't make myself very popular, but I was a lead negotiator, and I forced all the shareholders, including the corporates who could potentially be interested or not, I didn't know, to sign a letter that they will waive their right of first refusals in the next coming period. Well, you can imagine that certain corporate players may be easier, but when this goes to American banks or other banks, it takes a little bit longer before they really like you to sign such a letter. So the answer is corporate venturing is less harmful. When they're really the corporates, be careful. And also, to be fair, these corporates may sometimes have contacts with competitors, or I would be a little bit more careful, unless there's a very good rationale where, from an operational point of view, that you guys can help each other, and the stake is relatively small.
Yes, I would agree to that too. I had a situation where we had a corporate investor, so on the balance sheet, and in a second round of a large B round, they made then the offer to exit the company to them. So and there was actually a good price, so everything went right, but it could also go vice versa because they can block all the future transactions as a corporate, because they want to keep the company in their hands, but are not willing to pay a good price. So it's almost a blackmail situation sometimes, where the things, and have you seen that also playing by VCs? You talked about the waterfall. So for everybody in the webinar, normally I have different kinds of shares. Common shares are the ones with the founders and early investors, mostly angel investors. And then you get preferential shares with a liquidity preference. And mostly it's 1x, can also be 2x. When the money is hard to raise, you have to offer, or the investors are going for aggressive conditions. Then you have to do the waterfall. And then you see that an VC like has an offer on the table, 20 million, and he gets all his money back, but the rest don't get back. Have you had such situations, or is that very uncommon?
It absolutely happens. And I was in one situation that's quite a while ago, where there was 180 million in liquidation preferences. 180 million before the founders would see anything. And in this case, actually, the founders invested themselves 15 million. So they were completely underwater. And my advice to the founders is try to, now I'm giving founder advice, so I'm also on the
yeah,
other
but
side.
if you are in a board,
Exactly.
it also helps
Exactly.
because we're founder friendly.
Yeah, if you start with liquidation preferences that are more than a non-participating liquidation preference, or non-participating liquidation preference is like, once I'm an investor, the company is being sold, I have invested 2 million. Once I get my 2 million back, I participate pro rata. And there's no double dipping, that I can and get 1x my money back, and I participate pro rata. So really try to fight tooth and nail if anyone comes with a in most situations with a non-participant, or with a participating liquidation preference, or where the liquidation preference become 1x or 2x or even 3x. What you sometimes see in the situations where people give a convertible loan to help the company for them, but they think there may be an exit coming up, a little bit to the previous story, they may throw in a liquidation preference on a convertible loan for 3x for only like 18 months.
Which is great for them.
Which is great, but it is great for them. But the problem is, you set the tone. If you, with a Series A or earlier on, set already a 2x liquidation preference, you set the tone for the rest. I can tell you the next investor is going to also ask for 2x or 3x. So be quite careful. Now, coming back to that whole waterfall, that is what you really need to do, like make an analysis at what kind of exit value, who gets how much. And it can be tricky, yeah? It can be tricky, especially if there is an old anti-dilution clause still kicking in, or if you or you have these participating or non-participating liquidation preferences. Now, what happens if everybody makes money? There's no problem. What happens if it gets in such a way that the last investors, or the last group of investors, get money? And that becomes an issue, and they typically will help to make sure that the founders will get some money. And the founders, because the founders are important to perform the exit, to be facilitating the exit, to continue to work 1 or 2 years or 3 years with the purchasing company, with the acquirer. So usually the founders are not in a bad spot when it's a so-so exit. who usually gets smashed a bit are the earlier round investors that didn't have the funds to keep on investing and protect their position.
Yeah,
And
that's absolutely true.
They get squeezed in the accordion, if you like.
Mm.
So to the founders, even in a case where this is like personal advice, in a case where you can manage to return money, to base money to most of the investors or the investors, they will typically be open, the investors, to make sure sometimes they will waive then their interest or the liquidation preference. In certain cases, there was 1.5x liquidation preference. As you as a founder be able to find an exit where you can at least return the money, most of the time the investors will say, okay, fine with my 1.5x. I also want you guys founders to make a little bit of money and to continue working with the acquirer.
That's what the buyer has to do. He must make it attractive to them too, so he can do a little bit a better earnout.
Yeah, and that's then the fight. Who will pay for these earnouts? Is that the current shareholders, your current investors, or is this then the acquiring company who will make this that situation?
We always tell about investors. We as angel investors,
Yeah.
how likely is the chance that we can influence an exit?
It is a very good question. First of all, I believe that influence can be quite separated to the percentage you hold in a company.
We have low percentage.
Yeah. And that has to do with the relationship you can build up early on with the founders and the management team. And even you can potentially, you can have among the group of investors, if there are one or two of the lead business angels stays close to the founders, not by being in the board meeting, not by exercising your shareholder agreement rights, but just by being close and having a coffee and ask how it's going. And some of the business angels, they have fantastic, say, commercial introductions for these companies, or are just great people to listen to. Mind you, CEOs are extremely lonely, yeah? And especially in this fight between big swinging investors with big personalities. So there was this one company I invested in with 3i when I was working for for 3i. I mean, Goldman, V Ventures, Carlyle, all big names were in there. And it's interesting you asked it. And we were a later investment. Yes, we were a little bit. We had put in some money, but not that much as these guys. And the founder, he would sometimes call me on a Sunday morning saying, "Goldman asked me to come to London. What shall I do?" And it's about this relationship you build. But if you're an asshole in the board, the founder won't call you. You want to have a relationship where the founders will call you as an investor when shit hits the fan, but call a little bit in advance. And you want to have that relationship that happens. Now, there's a little bit of a war story. So what happened with this company is that I was driving back from the tech tour, that kind of Sven Linjaard from Vision or organized. It was a tech tour in the Netherlands. I was driving back. I was in a board meeting, and they asked, I was an observer, who's going to fund the company? And the CEO first asked me, will 3i still invest? And we had made our mind up, said that we would not invest anymore. Obviously, the other investors won't use the names too much. They were running for the hills. I flew to Geneva. I land. And I get a phone call from this guy, from the founder, who himself had put on, I think, more than 50 million or so. He was a quite famous guy. He was very high up in Cisco before. And he calls me and says, Alex, I just want to thank you for all your work. And I was the guy who in the board meeting said, we can't fund anymore. And what I want to say, it is you, as now I'm talking to, say, the SICTIC investors, It's about that relationship that you can build with the founding team. And if you have angles to help them or give them comfort. And what I said, these CEOs and founders can be very lonely. And nobody wants to admit that, because they have to be, the he and the she's have to be this type A personality, not always, but but they have to be confident and they want to raise money. But I tell you, founders can be very lonely. And if you understand that as an investor, even if you are a very early on investor, and you can help them and sometimes have a coffee to them, you can have way more influence than your shares. And almost sometimes, I mean, I was it myself many years. I was a young kid with a nice business card from say 3i, but who the fuck was Alex? I didn't have any freaking experience, never run a company. It was all the big money from the big name. It's very easy as a venture capitalist, you walk around very cocky and like, oh, I have the big business card. It's all about, and that is where I definitely think that let's say many SICTIC investors have nice relationships, can build it up and play such a role towards the management team.
That's good to hear, because I tell always in the master classes, be aware that your influence is getting lower and lower. And on the other side, we already covered that if you have a VC in who's going to have the majority of the shares through the liquidation preferences, yes, also be aware that they can steer the wheel, and you as angel investor just have to follow, and you will lost your dream to make your 10 or 20 or 100x, because what we have seen in the portfolios of VCs that they concentrate right now to the ones they believe make really a good exit, and all the other ones they don't care about it, or even exit if they can get 1x or a 2x.
Yeah.
Good.
So just some statistics last year. Around 30 to 35% of the VCs did not make any new investments.
Very bad.
Yeah, I'm sure you guys, you're also say aware of that. And now coming back to this exit planning, it is nice that you already early on start thinking when it is either plateauing and you look at your portfolio, it is very important that yes, you will always have, I mean, let's be honest, yes, you may have a 10x or 15x, whatever in your portfolio. How much did you really help that company, or how much was it already fantastic? Yes, you have companies that fail because it was just a mistake, and to Tampi, whatever, you lost it.
Let's go to the next one.
Try in a portfolio, if you can make sure that we rank them all as A, Bs, and Cs. So the A's are the stars, and the C's are like, don't spend time on it. But it's amazing that if you do well in helping these B companies not becoming C's, and working with management teams and founders that realizing that getting some money back is actually quite nice, and don't keep on going, but having had already exit discussion, having had already coffees and drinks, you talked already with your partners around the ecosystems, you bonded already, that when you think, well, not so sure I can get my next financing, it is very nice then from your portfolio as SICTIC or other investors that these Bs, you get the 1x. Do the numbers. I've done the analysis, and you take a whole portfolio of, you take the 20 portfolio companies, you start all ranking them. The ones that kill your performance are the B companies that you let drop into C companies.
That's right. Let's go to the questions.
Sure.
We have still 50 minutes left. Chandler, hi Chandler. Nice also to have you here. Often the successful exit depends on successful execution of a given strategy, for sure, because revenue, EBITDA good is always better than to have not growth and bad numbers in your balance sheets. And often it's about experimentation and pivoting and repivoting. So how do you hedge the potential upsides and downside associated with exit strategy driving the business strategy, and not the other way around? So it's more the question, you could turn the strategy a little bit or pivoting to please the exit, but if you're good in execution, it's not better to stay on good execution and just wait what happens?
Well,
because good companies are always be bought, because there's a few good companies and the rest is not crap but medium.
I mean, I would say,
mediocre.
No, I think it's a good question. Give me one company that has not pivoted, even successful companies, A companies, B companies, or C companies. So the fact that you pivot because you want to, I mean, let's be honest, you in this pre-series A or A and even post A is like you always want to find this good product market match that works. And you constantly change that. So I think having that good product market match is extremely important and should drive your company. But every time you make a pivot, look again, like, okay, what could be an exit strategy? So I think fundamentally you have to make a good product market combination. If you then start saying, okay, well, now we just made a pivot, we have a better product. Then the questions come as well, like, okay, do we still go very big in Germany? Or do we now invest more in this technology and we want the technology to be bought? And then also, let's be fair, also saying, okay, we haven't touched upon that really, is say, okay, we now have the right strategy. We did a bit of a say pivot. We have now these 3-4 companies who can potentially buy us. What do they need in terms of management? Is the founder, will the founder be stay capable of working in that company? Or would the founder and the management team say, let's hire a very solid layer under us that actually, when the purchaser buys us, they're less dependent on like a 1 or 2 people founder company. So coming back to the question, product market combination with a great upside and a great delta value add in your product delivery, that should drive it. But then once you make that pivot, start relating that again to what are the various exit possibilities and make then adjustments, say, to that.
Good. Yeah, sounds reasonable. I like the thought about also the founders still involved in that steady process, because if the founders are hesitating exiting, it's very difficult for us investors to have a good exit. That's my examples, many of them who just failed, or companies I have seen. Good. So will the slides be shared with you? Yes, Alex, you said you will share them. And somebody anonymous asked, should you include a sort of exit slide in the backup part of your pitch deck on raising money?
That is actually a very, I really like that thinking. And I would advise you to do so. You want to be a little bit balanced in which phase you are. If you're really early, you want to be, you can't really know it exactly. So please don't say IPO, as we already discussed. But the fact that you display to investors that you already think about very well, like, okay, what can be possibilities, gives confidence to an investor. And what I told you when I worked for 3i, it was mandatory for the investment executive to already write up what can be the potential exit routes. I have to say, when I speak to friends and colleagues in the VC market, not that many venture capitalists are doing that. They all talk about investing, how great the technology is, how great the team is, and hardly any. I don't think I don't know if there are any investors around the table, VCs around the table, but how many really write down in their investment paper to whom they can sell, besides saying, oh, there's going to be a software company from the US that's going to buy us who wants to go into Europe. So I think it's coming back to the question. I think you should do it. A slide depends a bit on the phase where you are, but that you demonstrate that you think about it, and you potentially may also do your business development towards potential exits. Again, I'm telling it again, the company is going to buy you, you know them already. 95% of the time. And therefore you want to start building that relationship. So if I would write that slide, say, listen, we are going to do some business development in these areas, also because we potentially think that these companies can be our acquirer. I think that's a very strong, strong message. And to be honest, you may even outsmart already your investor who is not thinking about that yet. Yeah.
Good. Next question. I'm a candidate to invest in a company and to do a management buy-in in Switzerland. I would be happy to connect with investors working on exit. I'm targeting a company well established in the consumer products, tech or services. How to facilitate this type of interactions? The market is highly hidden in Switzerland versus other markets around. Now, that's a complicated question, but just a short answer on that, Alexander.
Yeah, it's when you do a management buy-in, it is usually more like say kind of SME companies. So it's a little bit less say indeed visible as the venture capital market. I have some small firms doing it, and they often spoke to bankers who provided already loans to these SMEs. So that was one route of doing it.
It's more a difficult market anyway, because the investment sums are too small to really hire good experts, because they want to have a percentage of the exit transaction or the investment transaction. So yeah, I would agree to that too.
Yeah.
The next one is Scenario Corporate Investor Business Unit. Is interested in taking over Series A stage startup. Do you strong go-to-market synergies? It can be expected that revenues will grow by like 2-3x in the next 2-5 years, which is pretty good for a Swiss company. Revenue multiple before takeover would be rather low, so that the founders would be try to negotiate a large earnout. Given the previous comment on the capital gain tax, what needs to be looked at? Also, what is the typical ratio between immediate exit proceeds versus earnout 70-30? And well, that's several questions. Because of time, just a short answer on that one.
It's a very informed and well-formulated question. You will have here to fight a little bit with your current shareholders, like how much are they going to get and how much are you going to get? Especially, I would first fight extremely hard in that situation that the structure of with the capital gain tax is well organized for you, that you can leave when you can go to Hawaii and on the beach, but you can still sell your say your shares if the company does well. I would say I have not often seen that. It's more in the ratio indeed of you would make 60-70% right now at the acquisition. And up to 30-40% you can organize for yourself in an earn-out. Usually earn-outs are not that much long. I haven't seen earn-out periods for more than 3 years. It's usually between 1 to 3 years that can be negotiated. But that ratio, don't think you can get 80% through the earn-out. That usually won't happen. Yep.
And you have to be aware if the earnout is vice versa, 13 beginning cash, we as investors don't like it. And to have a 2/3 earnout is also, I think the buyer is not really fair to the seller.
Yeah, exactly. Yeah.
Good. Then how is the Swiss exit mentality different compared to other ecosystem? That's a funny question, because we're slow, not risk-taking. But maybe, Alexander, you can comment on that?
I just find it is, let's imagine we're having a barbecue in the US, in the Valley. Everybody talks about, oh, I'm probably going to exit my company in so many years. We have here in Switzerland a cheese fondue party, and people only talk about like, oh, we're building a great company.
Yeah.
So I do think it is on the agenda, but it's sometimes less a drive I find here.
Good. Then from Manoy, do we ask a founder as an angel investor, or if we ask what is your exit strategy, do we accept a reply from one of the objectives in the slide of Mr. Banz, or not sure the reply is acceptable? So it's more about the thinking of
Yeah,
the
I would really
founders.
listen to, I would really listen to how much they think about it. And also with you as an angel investor, it gives you a feel. Yeah, I mean, it's a discussion. What
Yeah.
do you think as an angel investor? Do you know people? You guys have a network that reaches. I mean, you probably, SICTIC is probably 2 phone calls away from all interesting companies here in Switzerland that can buy startups.
Okay. Now, Matt. Hi, Matt. How are you? Um, we mentioned the Metaco deal. It was one of the biggest fintech deals last year,
Yeah.
and you were in the middle of that storm. So maybe you can't answer, but so what was from your acting in that case the biggest challenges in the
Yeah,
deal?
no, no. I mean, obviously, all kind of NDAs, American NDAs
Yeah.
flying around here. Unless you guys provide me a lawyer like Donald Trump, I don't know, whatever, but and not pay the lawyer. But let's I can't comment on how Ripple. So they basically continued with the acquisition despite that their discussions with SEC. The thing that is public knowledge is that. Metico was in the same time also looking at doing a Series B and managing that process, managing a Series B of a very large number and running a exit process that was extremely complicated. But there was not a direct. To be fair, I can say that Ripple had their mind set up quite clearly, and it was in the end it was a relatively smooth process.
Perfect. Thank you. Just a last question from my side. We are now in the board or as investor discussing exit. The company is slow growing, and what would be the best advice? Should we hire PwC, KPMG, Ernst & Young because they have transaction teams? Should we hire a professional M&A boutique which is doing just exits or helping exits? Or should we go for a transaction advisor in first, keep them, and then he makes the team around? So the question is more, should we look for exit possibilities or should we hire a professional? What would you recommend? I
Yeah,
mean, I've
I
seen
would
so many cases, and for us, it's always the question, should we do it ourselves or we should hire somebody? And explicitly, it's not a company which is super growth and super profitable.
Yeah, I would first sit down and do such a session with take the slides or whatever internally, because the PW the say the larger advisors, they're very like more focused initially at doing the transactions unless you want to pay them a nice retainer that to help you through the whole thinking. But I think it would be weird. I mean, you the board, you the investors, you the founders. But I said, in 95% of the cases, you know the buyer already. It would be very weird if you need to hire an M&A advisor to tell you who would buy you. So my strong advice is take an afternoon, open a bottle of wine or a cup of tea, and start to brainstorm. Who are these? Who are the 10 buyer? Who are potentially are they, and why? You should be able to do that yourself.
But if you have a company in your sphere which you know you could sell your company to, which would also be an ideal candidate. They already did M&A, but you have to approach them. Is it then wise that the board or the founders approach that company,
Usually
or
what
you
you do,
use
yeah.
just a transaction advisor because he's a very professional? Maybe he's also making a nice exit pitch slides or investment memorandum, which is
Yeah,
much more professional than whatever normally we can do on our side.
sure. It's a bit of if you guys are experienced investors, you also say experienced business people. If you know if you know those five, you have one potential buyer. It would be very weird if you can't find an introduction to that person, or to the chairman. Ideally, I would not let the CEO founder contact the other company. This is a very typical job for a board member or a chairman.
Very good. So we finished time. Thank you very, very much.
It was a pleasure.
It was a pleasure to me too. Unfortunately, we could answer all the questions. I just take over some news slide. Let me see that. Next one. Oh yeah, we have our next SICTIC Investor Day. It's an online event. Here you can scan the code. We will be happy to have as many visitors and attendees as possible. My final word to exit, it's, as I said, investment is easy, exit is extremely difficult. Alexander, thank you. And the rest of you have maybe a late lunch or a sandwich, and hope to see you soon in one of the next events.